Video 10C is about S-Corps. These are another common pass-through entity. S-Corp tax law is pretty similar to partnership tax law, so we mostly cover the significant differences between the two. Let's get going. From a state law perspective, an S-corporation is really just a corporation, which we often call a C corporation, just to note the difference. It is just that this corporation has made a special tax election to be treated as a pass-through entity. Since the tax laws are housed in subchapter S of the Internal Revenue Code, the common name is S corporation. S corporations have been around much longer than LLCs, and when originally offered by the tax code, the liability protection came at a cost relative to the partnership. The allocation of income and deductions is not anywhere near as flexible as with a partnership. Because legally the entity is just a corporation, allocation of income must follow state corporate law, which generally provides that an owner's share of income is based on the pro rata share of ownership. For example, if Susan owns 25% of the S corporation stock, she's going to be allocated 25% of the ordinary income, gains, losses, and other separately stated items. There is not an S corporation agreement that provides for a different allocation. Like a partnership, an S corporation files an informational return, but as a pass-through, doesn't pay any income tax. Also like a partnership, page 1 of the tax return aggregates the ordinary business income. Also like a partnership, the S corp return includes a Schedule K, where the ordinary income and other separately stated items are totaled for the entire entity. And also like a partnership, each owner gets a Schedule K1 that provides that owner's amount of each item. S corporations have some restrictions on owners. For example, only a domestic corporation can make an S election. The corporation must have 100 or fewer owners, and owners are restricted to individuals' estates, certain trusts, and nonprofits. Thus, a corporation cannot be an S corporation owner. And S corporations may only issue one class of stock. Basis is as important for S corps as it was for partnerships and is largely treated the same. Loss limitations, distribution taxation, etc. But there is one big difference. As a legal corporation, the owners of an S corp are not liable for the debts of the S corp. If you go back to Jack and Jill, who borrowed money, then invested, and Mac and Lil, who had the partnership borrow, there was no economic difference. However, if the entity is an S corp, there is a big difference. Mel and Lil would not be liable for the debts of the S corp. As a result, S corporation shareholders do not get basis for the S corp's debts. There is one way in which debts can be included in basis, and that is where the S corporation shareholder loans money directly to the S corp. That amount is included in basis, but categorized as debt basis, which is accounted for separately from stock basis, which think of as all the other basis. So if Marty is an S corp shareholder and his basis is less than the loss being allocated to him by the S corp, if Marty wants to be able to deduct the entire loss, one of the steps he could take is to loan money to the S corp and therefore create additional basis and make the loss eligible for deduction. As I've mentioned, an S corp is really just a regular old corporation with a tax election. And as a corporation, it pays its employees, including its shareholder employees, wages for services performed. Thus, an S corp owner that works for the S corp is going to receive both wages and an S corporation distribution. And the taxation of these two things differs. This creates a friction point between the taxpayer and the IRS, as the taxpayer is likely to wish to minimize wages that are subject to employment taxes and maximize distributions which are not subject to employment taxes. The rules require that an S corp pay reasonable wages for the services performed. Let's look at an example of what causes the friction. Stan's S corp has $150,000 of income before paying him any wages. If the S Corp pays Stan wages of $100,000, then the S Corp deducts the wages and the related share of employment taxes. The remaining income of about $42,000 flows through to Stan, and he pays income tax at ordinary rates of about $12,000. When all is said and done, Stan gets about $94,000 of the $150,000. If, on the other hand, Dan has a similar S Corp with the same income but elects to pay no wages to himself, his after-tax take is $108,000, which differs from Stan by about $14,000. This puts S Corporation shareholders in a position of wishing to minimize wages and constantly testing what a reasonable wage for services is. The tax court system is rife with cases on this topic, and again, true tax reform would have addressed this issue, but it did not. And speaking of did not, I did not go any further with this topic. Hope you enjoyed video T10C on S corporations. Thanks for watching.